Okay, welcome to our August 2026 podcast. My name is Brett Hina from Cornerstone Private Wealth Management. And as always, I'm here in the studio with my partner, Dan Lesneski.
Good to be back, Brett.
We are in the dog days of summer here, Dan. So, hey, and by the way, I was looking at my notes this morning. We have Joe here from Studio Recording, our producer here. Today is our anniversary. You know, we've been doing this every month for 5 years. So 5 years in a row. And full disclosure, I think we did, Dan, miss 1 month, and that would be April of 2025 for some technical difficulties. But we made up for it. We did double the next month. So we have not missed a monthly market update in 5 years. So that's consistency. Way to go, partner.
Yeah. And we wouldn't have been able to do it without Joe from Sweet Recording. I mean, they really, it's been such a great boon for our endeavor here, and it's kept us professional, on time, and on task.
Yeah, so if you need a studio, Joe is here in Voorhees, New Jersey. As Dan said, Sweet Recording. So he does. If he can make us look reasonably coherent, he could do a great job with you. You guys can do that. So, and actually, we've caught some fire a little bit with the podcast. Just over the last 2 months, we've had. I'm looking at different media quotes. We've had Barron's, a request from U.S. News and World Report, one from CNBC, and one from Investopedia. So we're getting a little pickup in the press. Dan will be a celebrity in no time. So keep it up, Dan. We'll see.
Doing my best.
We'll see how things go. No, and I feel a little bit, I got to say, the podcast, since we've been getting these media requests, I feel a little bit like we're the Wilt Chamberlain 100-point game. I don't know if you know the story behind that, Dan or Joe in the studio here. But that was in 1962, Wilt hit the 100 points. And I think it was in Hershey, PA. It was a super small stadium, like 4,000 people. And what happened was, the story goes through the decades, like a couple million people have said they were at the game. So everywhere I go, I hear people, they watch the podcast, they pass the podcast along. Well, we were looking at the numbers this morning, and we're getting some good traction, but it's like 500 people on YouTube and Apple Music. So everybody tells me they're passing it on. So I feel like we're a little bit like
Hey, at some point we'll have that 100-point game. It'll be good.
We'll keep shooting for it. So this podcast this month's going to be fun, Dan. We could riff on because we got a great topic to talk about, and you're going to hear a term multiple times. Maybe you can count. Maybe it'll be 100 times I say, don't use leverage. So that's going to be our theme of today. Do not invest with using leverage, because we had another blow up, a spectacular blow up this month. So that'll be the first thing that we are going to talk about. Just to set it up a little bit, I know you've been following this story very closely, and we'll call it the rise and fall of this situational awareness hedge fund. Spectacular story. So this guy, Leopold Aschenbrenner, we'll call it, 25-year-old. So Dan, we'll let you kind of riff on this for a little bit, but a 25-year-old, and he was a former OpenAI employee, and he published this paper, 165-page like AI treaty titled Situational Awareness a few years ago, and that led him to launch this AI hedge fund with the same name. He rode the wave. It looks like, from looking at the numbers, he went from he started with 2 years ago with a few $100 million, right? And then he got up to it looks like $45 billion.
Yeah.
In fact, just in June of this year, he sent out a letter to investors saying he was up 439%, send me more money, which they did, and it blew apart. The whole thing had to be sold out at a fire sale just at the end of July. So that was crazy. He used a lot of leverage. So Dan, what are your thoughts? What happened there?
Well, it's kind of a classic story, and it's funny. One of the books, we have done summer reading earlier, but Andrew Ross Sorkin had put out a great book earlier this year about kind of 1929, the famous stock market crash, and one of his theses was essentially that every single one of these major pullbacks in the markets, or in this case, in an individual hedge fund, is kind of a story about overutilization of leverage, and I think. Over the course of the summer and certainly over the course of this year, we've seen that story play out time and time again. Right. Whether it's the increase in leveraged ETFs that we've seen since April, I think the market share of leveraged ETFs since April of 2026 has increased by over 60%. Mm-hmm. Right, which is a wild stat. You've seen that in foreign markets, especially in the Korean market, where leverage has become such a household, part of everyday life that at one point I think it was 1 in 3 Koreans were margin called.
Right.
In 2026, not market participants, but 1 in 3 Koreans, or South Koreans, I should say. So I think this story is kind of very, very much a part of the 2026 zeitgeist. It's just that leverage has come in. People are very passionate about the AI story. Obviously he was an insider being at OpenAI and having a real, fundamental understanding of what's going on there. But leverage is kind of the great equalizer in that way, and that, it only takes a little bit of bad news to undo all of those positive gains. And I think I wouldn't have wanted to have the week that he had. I can't imagine having to call clients with that news.
Yeah, and what's amazing about this blow up, so he had to sell out all of his public equities. We don't know the full story; is just kind of coming out, but to Ken Griffin's firm at Citadel,
Yep.
right? So, but the markets haven't done too bad. It wasn't too crazy of an environment. So what we have, and we did have in the month of July, a 10% NASDAQ correction. And we'll give you plenty of examples of leverage and how leverage has blown up a lot of different firms in the past, but not usually during an environment where we only have a NASDAQ 10% correction. I think you're right. It does point out the way leverage works. But even a 10% NASDAQ correction, so maybe it would have been, and it was about 30% peak to trough with some of the higher momentum stocks. Certainly he had concentration in that fund, and he was investing in the more aggressive stocks. But let's say, if those stocks are down 20%, if you have a 20% decline, let's say you have $1 million portfolio, in this case, 45 billion, but same thing, but $1 million portfolio, if you have a 20% decline in the portfolio, it's painful, but you're down 20%. You have 800,000, it's recoverable. But if you have a two-time leverage, pretty simple, now that same 20% decline, now you're down from 1 million to 600. You can see how that's a bigger deal. Take that to 5 times leverage, and you're wiped out, right? Your same $1 million at 5 to 1 leverage is wiped out, and that's kind of what has not only has happened here in this particular case, but has happened historically multiple times.
It's a vicious cycle too, because what ends up happening with that leverage is you start to experience real pressure in a fund or in the market, and then you've got lenders that have provided that liquidity to you. They want their money back, right? They want to be protected, so you start having to sell assets to meet those margin calls, or to at least get your risk in an acceptable range for your lenders, and that adds to the pressure that you're already experiencing, right? Those securities now that were under pressure are now doubly so, and you get this vicious cycle. So, I think you saw first half of the year is up north of 430%, and then in the month of July, down north of 60% on that fund. That is a wild, wild ride.
Yeah, and I heard at the low, maybe 76% went that day. But if he could have held on for one more day, you had that the momentum index rally 7 to 10%, which would have been last Friday. But you can't hold on, because what happens in that particular situation, he's leveraging from these banks. So when the banks they mentioned the margin calls in South Korea, and we'll talk about that more, but they want their money, right? They want their money. The only way you can get the money is to sell the securities, and they want the money that day. So there's a fire sale.
It's very interesting. Going back to South Korea for a minute, I saw I saw some headlines about the regulators essentially disallowing, levered ETFs. One of the things that was shocking to me is that I think they still allow for inverse levered ETFs. So you've seen the populace that was heavily investing in these levered ETFs, especially around kind of memory stocks. DRAM was a ETF in the U.S. that was heavily traded on over there. And now, shortly after that change in policy, now you see them piling into the inverse levered. So I'm sure that story won't end poorly.
Yeah, so the key is do not use leverage, right? Have some situational awareness, which was the name of this fund, but I don't think he had real situational awareness. It was great on the upside, right? But on the downside, you could see where if you have, and I think best guess we think is about 3 to 3.5 times leverage. So if you have 3.5 times leverage, and you lose 70% of your money that you don't even have because you borrowed 3.5 times, you can see where that fund could evaporate
Oh, yeah.
in that one particular month. So, or and you know this, the advent you mentioned, these 2 or 3 time leverage funds, they're out there. We see them. A lot of people in the U.S. use them, but South Korea, you're right. I don't know what. I guess it's kind of a gambling culture over there, because I remember a couple years ago we had the same problem getting margin call, or they were getting margin calls in South Korea with crypto stuff.
Yeah.
Right. So now you look at by some accounts, 1,200,000 households in South Korea getting a margin call, right? And then and they said something like, they don't know the full number, but maybe I heard 400,000 people completely wiped out of by the margin call. So they're utilizing. So what was happening? Not only were they utilizing 2 times upside, but that market is totally controlled by 2 companies. There's
Samsung and Hynix, right?
What are they, like 40% of the market? So
Yes.
40% of the market's in
So
2
you've
stocks.
got compute and memory,
Right.
And that, it's. I wonder when I look at this and I look at kind of the trend, in the U.S. as well, right? Gambling has obviously infiltrated every aspect of life, right? Whether it's gambling on political races or wars or sporting events, we've kind of gamified almost everything. And, part of me looks at it and goes, Korea is very similar to the U.S. as well in terms of like a wealth disparity. And I do wonder sometimes if people look at this sort of stuff and say like, hey, the only way I'm going to get ahead is if I take a really big bet and it pays off. And we've created these kind of financial tools to enable people to do that. And I think it's in the short term, it seems like it's bad. In the long term, I worry it could be ruinous.
And the convenience factor, too. It's one thing to, back in the old days, where you have to show up at a Merrill Lynch office and buy a stock, right? Now, to have it on your phone just makes it easy. To be able to utilize leverage and invest 3 times in an aggressive asset on your cell phone is ridiculous.
It makes you almost, think back wistfully for the days of just trading 0-day options.
Right.
It has gotten nuts.
But it's been going on. I mean, there's 2 areas. There's leverage, and then there's investing in bubbles. The other lesson we'd bring from last month is if somebody calls you and says, hey, we want you to invest new money in a fund that's already up 439%. It's up 439% through half the year. It might be a bubble. It might not be a great time to put your new money into it, but people do it. I have examples in front of me of different bubbles through the decades, and they just continue, right?
No, I love this. I know you had a great piece you saw out of the Wall Street Journal, and I love this concept, and it'll be curious to see over the coming months and years as the analysis on this gets a little deeper. But this mini bubble theory, why don't you tell everybody a little bit more about that?
Yeah, I think you're referencing the article I have in front of me. It was in the Wall Street Journal. It's called "America is Great at Creating Stock Market Bubbles and Shrugging Them Off." So it gives some examples. Not from, and you can go back to long-term capital management, where there were Nobel Prize winning economists and legendary traders, and that was in 1998. That blew apart, had crazy rates of returns, but we don't have to go back that far. Here's a brief recap of, over the last decade. We had, I forgot about 3D printing. So there were 3D printing stocks in 2014, a couple of years, 13 years ago. They lost about 93% from their peak. So pretty bad. Big investment boom, anything China-related stocks in 2015. Next year after that, shortly thereafter, those stocks, the China stock market itself went down 47%, okay? There was these low volatility trading vehicles that came out in 2017, 18, had 92% loss from some of the stocks that came out. And remember the SPACs?
Yep.
The SPACs, clean energy, cannabis, the space and crypto funds that came out in 2000 to 2001. Remember the ARK Innovation Fund that was up tremendously, lost in 2021, lost 82%, right? So,
and still, even if you look at even the performance of ARK this year, it's been wildly volatile. But it's I do think there's something to that. It seems like capital now, rather than being completely destroyed by these mini bubbles, it just kind of rotates, right? We're going from one theme to the next. I used to laugh. One of my partners at UBS in years past would always quote Wayne Gretzky, and you got to know where the puck is going. But he was spot on with we're going from one theme to the next, and you get these sort of mini bubbles, these parabolic runs, and then a correction, rotate. I mean, you even look this past month at the disparity between growth and value.
Right.
Right. It's another thing, right? That theme, AI trade takes a pause. All of a sudden, value stocks, banks, et cetera, are just ripping.
Yeah, look at we forgot to mention because they're super micro. How about Allbirds? Remember the Allbirds? They used to have a cup, shoes. That was a shoe company. They rebranded it to named it New Birds AI, and now they're called Smart Bird. And so they tried that they were in casual shoes, and then they became Smart Bird. But they're down 85%. Same with super micro computers. Some of the crypto, not to mention, has down more than 50%.
Look at crypto. Look at just strategy, right?
Right.
You think about that. Think about the company strategy, Michael Saylor, and how much that thesis has changed from never sell. You're holding your Bitcoin forever. It's an infinite money machine to selling constantly, right? And the price of crypto, you don't even hear people really talk about crypto at the moment.
Right. Yeah, because it's down 50%. It's really the only business where people want to buy something that's already up. Yeah. When it's down in value, I was talking to some clients when Microsoft was down 30% year to date. I thought it was a good stock to look at a few weeks ago, but that people would rather buy a 439% half-year increase, right? Which is crazy. But you mentioned this rotational theme, and I think it's something worth digging into, and the Wall Street Journal alludes to that maybe the money doesn't pull out of the market. It rotates into other sectors. But I'll bring up the second item we might want to cover today is I'll call it like the revenge of the value stocks. Could be a new movie in a theater near you. But if you look at it through the end of last month, who would have thought this in January? If you go back, I mentioned 5 years of podcast. If you can go back to our January podcast, I don't think Dan and I said, hey, through July of 2026, you're going to see the large cap value index up over 20%. And the large cap growth index will be flat. That's exactly where we are right now.
Wild.
So 8 months into the year, you have value stocks outperforming growth stocks by 20 points.
It's a good case for diversification.
Right. And even international value, if you look at international value stocks, same story. They're dramatically outperforming growth. And that's really surprising and then we have some individual winners in that area. In fact, if you look at Microsoft and Amazon recently in their recent earnings over the last couple of weeks, they seem like the big winners, and the cloud growth seems to be the amazing component with those two companies.
That's why I know we've kind of talked a little bit internally too when we talk about the AI race, right? And you've got the hyperscalers, and you have obviously the kind of open source versus closed source AI models, and everyone gives the headlines to OpenAI and Anthropic. But I look at a company like Google where, their AI model Gemini is not quite as loved at the moment, but man, do they have a real business underneath, and they are just, they're capitalizing on all that spend,
right?
Between search and cloud, and I mean, it's really pretty incredible.
And if you look at the valuations of some of the tech stocks, because earnings are growing so fast, you look at forward earnings, might be, even for the overall market, if you look at the fourth quarter, might be like 20 times forward earnings. So the earnings are growing faster than even the stock prices. So it's making things look reasonable. But do you think that the cloud, you're our resident tech expert, but you see Meta, for example, Facebook, right? Not having the real cloud growth. So is it all about having a cloud?
No. I mean, it's so obviously we're not going to run out of any need for data, right? In the near term, right? So I think there's still a lot of cloud application and growth that's going to be coming out there. But I think what's interesting is they have less of the ancillary services surrounding cloud that Microsoft and Amazon and Google and things like that do in terms of being able to really monetize that and having longer, stickier businesses. Meta has, I mean, as far as hyperscalers go, they have really gone out and built serious amounts of compute. We just haven't seen it translate as much back to their, say, advertising growth. Right. So they've done all this CapEx spend, and while they've certainly grown advertising, it hasn't been kind of that exponential expansion that I think people want to see. Right. So we're kind of in that zone right now. We've been talking about this throughout the course of the year with AI. It's like people are starting to do the math on this CapEx and saying, like, at what point is this just lunacy, right? Like, are we ever going to get real value back from the CapEx that we're spending? And I think in some cases, the market's going to start to bifurcate, and you'll look at a company like, an Amazon or a Google or a Microsoft and say, yeah, probably they will get a real return, and maybe Meta will as well. But I think right now that's why you're seeing some pressure, and it's a little bit less love than some of the others.
And I think Andy Jassy from Amazon, from listening to the analyst reports in his most recent earnings, probably did the most articulate return on investment explanation in the markets. And Amazon's been very well rewarded for that CapEx spend. I mean, it's amazing. These companies are earning records amount of money, but they're spending all their free cash flow in, whether it's cloud or AI components. But I think seems like Amazon and Microsoft have really turned the corner this particular quarter, and we're really starting to see ROI from that investment, which could be pretty exciting.
Absolutely.
So we'll see if that continues. So the third theme, probably the final theme, so obviously we want to talk about don't leverage, right? That was the thing. Talk about value. And then we got to talk about the Fed, because we had a really interesting meeting last week. So it was the new Fed Chairman Warsh, his second meeting, right? He didn't say a lot. He got pressed a lot by the press, no pun intended there, but and they decided, everybody knows, last week to leave interest rates unchanged. And again, it was a divided vote. We had grown accustomed to this unanimous vote, 12-0 vote for many years. And we had 8-4 last time, 9-3 this time. All regional Fed governors dissented, the three of them. And he's definitely, the new Fed chairman is definitely, Dan, taking a different path. And his path is going to go back to Greenspan, and his plan is just to not say a lot, right? Remember, Greenspan famously had a thing called the briefcase indicator. And we would watch the NBC, and since he would never talk to the press, you would actually see him walking in. If he had his big briefcase, we thought maybe he would be, tinkering with interest rates because he had more information, and that's what you had to resort to. And he said things like, and I'll butcher the quote, but I remember the one thing, he's like, if you do understand me, what I'm saying, maybe I'm not speaking unclearly enough. He said that multiple times. That was a funny thing, because he was very, very encrypted. And then what we had from the last couple Fed governors, they've pretty much have been telling you exactly what they're going to do. They didn't want surprises. Now we're going back to the surprises.
It seems like, it seems like based on that press conference and the first two that we've had, is he wants the market to do the work.
Right. That's what he's saying. Right?
And I don't know. I don't know quite how to feel about that yet. Right. I think there's probably some merit to that idea, but people are really going to have to get used to a new regime where there's limited, if any, forward guidance. And, I thought the market reactions when Jay Powell got up there were not great, but so far, they're definitely testing our new Fed governor.
Yeah, and there was a 1,000-point Dow sell-off the day of the, and it just got worse and worse after the press conference. So they made the announcement that they're doing nothing. Then he had the press conference, and then as it started to unfold, the Dow was down 1,000 points, and it snapped right back the next day. It was up 650 the next day, so no big deal. But you could see the press was a little frustrated, and when I think the press really wants to see a fight, because it's not great for the press. They've grown accustomed to being able to have access to all these Fed governors, have plenty of comments. If they go back to a Greenspan environment, they're not going to get the coverage that they need. So you can see I think the press wants a fight between Warsh and President Trump, which they could easily do. I think if Warsh does not lower rates, there's definitely going to be some tension there with Trump. We'll see where that goes.
Yeah, I mean, put it this way, it would be a big reversal out of the president if
Right.
if that wasn't the case at some point. I think he's giving him some time to settle into the job, and and it's not helpful, to that thesis that inflation continues to be sticky and problematic, and we continue to have very volatile oil prices as a consequence of the ongoing situation with Iran. Tariffs are kind of back in the headlines again.
Right.
Right. With, essentially anywhere between 10 to 12.5% tariffs on essentially all of our major trading partners on all goods.
Right.
So, I don't see a lot of catalysts for inflation to go away in the near term, but.
Yeah. I mean, and one thing to keep an eye on too is bonds, right? The 30-year Treasury, it's been well documented over the last couple of days, is now over 5.25. Put a timestamp on it. We're on August 4th recording this, so you'll be able to see it over the next couple of days. But that's the highest level for the 30-year bond since 2007. So the concern there, the thing to keep an eye out there is as you get above 5.25 for a 30-year Treasury, bonds start to be a competition for stocks, right? Because if you can invest in treasuries and there's some state tax benefits of that, and let's call it a effective yield of say 6% for people or higher, you're looking at a treasury that's darn near the long-term annual rates for stocks, right? Mm-hmm. So that creates some pressure. So we'll see where that goes with interest rates. Now it could be, and some economists are saying that maybe the Fed, even because remember they tinker with the overnight money rate, so they could lower or raise, let's say the federal funds rate, and maybe the 10-year, which is what mortgages and everything would be based on, could go down in that environment. So we never know, right? It's not a correlation.
Yeah,
what we're seeing is a steeper yield curve, and the yield curve is how treasuries trade from the very short term all the way out to the 30 years. So that 30 year is something to watch.
Absolutely. No, I couldn't agree more. And, we're having more of those conversations as well in terms of, I think bonds are getting a little bit of a deeper look these days. Certainly a lot of money still in money markets, right? And we've been having that conversation for years where, the reason was to move out of money markets because rates were going to go lower. Now
right.
They've been persistently high for longer, but it sets up some interesting opportunities there. But something to definitely watch. Hey, I just want to get your take on something as well. Speaking about the Fed, speaking about the economy, what did you make of the U.S. GDP print, and then also the Eurozone print came out, and for the first time in a while, it was higher than the U.S. print.
Right.
And I don't know if you read anything into that or if it was a little bit of an aberration, but I was curious what your thoughts were.
Yeah, I think the U.S. GDP print was interesting, and that was a lot of it was housing related, right? So that's and that was what was it? Were we at 1.5 for the second quarter, which was a bit lower than expected, and certainly lower than the first quarter. So, but a lot of it looks like it is housing related, but housing throwing back into the mortgage rates, I think could be a concern for the third quarter because mm-hmm. housing's a decent component there, and we're seeing, so goes the 10-year bond, so goes mortgage rates. So we're seeing also last week mortgage rates are at a year high too. So that could hurt growth a bit.
Yeah, mortgage rates are high, and we've seen it's like 3 months now in a row of declining home prices.
Right.
So I don't know. It's just an interesting setup, but. It seemed like on the Eurozone side, I think they eked us out. I think we were 1.5. They were right around 1.6, maybe a little bit higher. But when you go and look at an underlying level, Germany was slightly higher, right? No contraction there, which was a positive. Spain was like the big winner.
Right.
Ireland, after having a terrible Q1, had a pretty solid Q2. So you saw a lot of the right. underlying economies that they needed to perform. And I wonder if that trend right now where, over the last handful of years, there's been a really strong case for diversifying abroad and especially Eurozone has done very well. I wonder if that trend persists.
Right. Yeah, you wonder because that, we had 2025, international outperformed domestic. But you wonder about how long, if it wasn't for our AI spending here that we talk about every month, it would be a lot slower, right?
Oh
So
yeah.
they don't have as much of that, but they're starting to get some of that. So that's, you know, that CapEx expenditure, if that doesn't increase the way we're expecting, that could slow things down. So So let's wrap up some of the lessons from this month. I think we've hit it pretty hard. Don't invest in a fund that's already up 439%. I think that's a good general investing advice. In fact, if it's up 439%, maybe ask why and say, hey, are you utilizing a lot of leverage? And don't accept the answer if they say, don't worry, we have a lot of situational awareness. We can navigate those because, that bubble has come. And don't invest in, you haven't heard us talk about these 2 or 3 time leverage ETFs because leverage works on the upside, but also works on the downside, right?
Absolutely. And you really have to understand some of these products. And, there's a lot of components, a lot of pieces. It ends up being like investing jambalaya where you're not quite sure what's in there. And, really, if you have questions or if you have interest in that area, please give us a call. Let's talk about it and let's see if these things make sense. And I would say for most people, most investors, most retirees, there's probably not a great use case. But if you have interest, certainly you should call us.
And sometimes, we overcomplicate things. Here's a year where it's simple things like dividend growth funds.
Yeah.
You look at SCHD, which is a Schwab dividend growth fund that we use, or Vanguard dividend growth things. They're doing great. I mentioned the large cap value index up 20%, and then we overcomplicate it as an industry, and people want to go into, these levered ETFs when they have solid dividend funds. So I'm thankful that we've kept that balance between growth and value, because the people that are really investors that are having a really difficult year are people that are overweighted in the growth sector. And we're seeing people, 8 months into it that are down for the year, but they've invested in the hot sector that has contracted over the last 6 weeks. So it's unfortunate. So it's still a good time to have a balanced portfolio, growth and value. Because now I think if you look at I like Morningstar does a great thing on their website. And right now they're showing that now value is overvalued compared to growth. So now and then I'm hearing from other investors saying, hey, maybe I should do more value. That's already up 20%. So maybe it's a good time for growth. The idea is to kind of keep things balanced.
Yeah, it's just one of those reminders, right? That having a diversified portfolio and not trying to constantly chase the hot dot, right? You might give up a little upside in a scenario like that, but you'll be happy in times of volatility and you'll have a reasonable rate of return. And I think we all have to constantly fight that urge of trying to figure out what's the next greatest, best thing out there, and sometimes just stick with what's tried and true and what works through multiple environments.
Yeah, it's always fear and greed, right? And these hot funds come up, and then people get greedy and they go in late after it's already up a lot. So, so again, the summer, dog days of summer, but we'll stay on top of things, and it is exciting that there's something to talk about during an August podcast. So thank you all for your trust and confidence, and we will see you at next month's broadcast. Thank you.
Take care, everyone.
Cornerstone Private Wealth is an independent financial firm helping individuals create retirement strategies using a variety of financial and insurance products to custom suit their needs and objectives. Cornerstone Private Wealth Partners provides all investment advisory services through Concurrent Investment Advisors, LLC, an SEC-registered investment advisor. Concurrent Investment Partners, LLC, DBA, Cornerstone Private Wealth are not affiliated companies. The items discussed are the views of the presenters and not of Concurrent Investment Advisors, LLC. The information provided in this podcast is for informational and/or educational purposes only and is not in any way to be considered investment advice nor recommendation of any investment product. Past performance is not a guarantee of future results. Investments can fluctuate and when redeemed may be more or less than originally invested. Concurrent Investment Advisors, LLC and Cornerstone Private Wealth is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing insurance company. Please consult with your attorney, accountant, or tax advisor based solely on your individual circumstances.